I'm joined now by Steve Sjuggerud, the editor of the Stansberry Research publication True Wealth. He was our lead-off hitter last year at the Vancouver Symposium on Natural Resources, and I'm very happy to say he'll be back again this summer joining us. Steve, thanks for joining me today. It's been a while. How are you?
I'm fantastic. You know, I love going out to the Vancouver conference, and I always kind of joke, I wonder why Rick invites me back, because every year I try and say something that is that's going to twist people's stomachs a little bit, but hopefully turns out to be correct. And I think it was 2 years ago I stood up in front of the crowd and said, I'm selling all my gold and all my gold stocks now. And I feel like every speaker after I spoke had to say, well, Steve might think that, but here's why I think gold's going to go up. Everybody had to defend themselves after my speech, and I thought, oh no, Rick's never going to invite me back to the Vancouver investment conference. And but I love going out there, and I appreciate you guys inviting me every year. It's a good time.
Well, Steve, we kind of share a common mission as you at Stansberry Research. We're not here just to toe the party line, and that's one of the things we really appreciate about you, is that we don't know what you're going to say when you get up there. And as you mentioned, I think last year, the year before, Porter doesn't know what you're going to say when you get up there.
That's
so
right.
I think it's great for the audience. It's really builds some diversity into the conference lineup. So we want you to keep doing what you're doing. We may not always agree with what you say, but we certainly appreciate the fact that you're coming from an honest point of view, and that you say it the way it is. So I want to revisit some of those calls. You've had some great calls over the years, but before that, maybe not everyone watching this video has seen you or has had the chance to listen to you explain your method of investing. It's not pure value, it's not pure trend or technical. Can you talk about the criteria that you look at when you're selecting investments?
Yeah, I think it's a great question, a great place to start. Because I actually feel like I sort of have no friends in the investment analyst world, because there are two camps really of investment analysts. There's a camp that's pure value guys, and I'm going to buy straw hats in the wintertime. I'm going to buy investments that are cheap. If the cheaper it gets, the more I like it. Those are value investors. And then there are trend investors, and they just want to buy what's going up. And if it's, as long as it's going up, they'll buy it, and hopefully they'll get off before the trend is over. And so those are the two camps, and they seem like they're exactly the opposite. And but what I believe in is that I want to buy what's cheap and in an uptrend. So there's really three things I want to see in the ideal investment. I'm looking for an investment that's cheap and that's hated and that's in an uptrend. And so the value guys think, well, Steve, how do you believe in that trend garbage? And the trend guys say, Steve, haven't you seen that the trend stuff outperforms the value stuff? But I've had the great thing about this idea of looking for what's cheap and hated and in an uptrend, it's sort of an uptrend, is that it really works across all asset classes. As long as you can learn how to define what cheap is or hated is in a particular asset class, this style of investing works in currencies, works in commodities, works in stocks, bonds, real estate, you name it. And it's really been a great sort of barometer of where you are at any time in any asset. So I kind of think of myself as a jack of all trades, but a master of none. But as long as I see this setup, and I usually I don't have to be the expert when you see that setup. So yeah, I mean that's the basis of my philosophy. I'm looking for what's cheap and hated and in an uptrend.
Your criteria might be applied equally well to investment analysts, because after that conference where you said you sold all your gold stocks and the crowd reacted to it, I was going to recommend a strong buy on Steve Sjuggerud as being cheap, hated, and in an uptrend. And certainly, as far as the uptrend, went, I mean, you did very well.
I was cheap and hated. Yep.
Well, the next year, I think you were vindicated. You came back and you showed what happened. You'd sold pretty much at the right time, much to the chagrin of many of us in the audience. I mean, we have to give you your due. So let's start there with gold stocks. You recommended them. You made very good money on those. You sold them. We saw it retrace. Where are you now on the gold stocks?
You know, I am still not a buyer yet. I have not bought gold stocks myself personally. I have not recommended stocks. I keep watching. I keep looking for my opportunity. They are certainly cheap. They are certainly hated. And they've even gone beyond hated to the point where it's really ignored, which is wonderful. I mean, the world is not paying attention. So we're very close, but I have not been a buyer yet. And maybe by the time the conference rolls around, we'll finally see, all of the stars align, and it'll be a great time to buy. Now, I will say that I did buy gold personally. It was probably November or December. It was right in the sort of the Bitcoin frenzy, and I thought, wow, this is just insanity. You just don't see crazy things like this, and people that might have bought gold were abandoning gold. But some people that may have bought gold were abandoning buying gold and buying Bitcoin instead. And I felt like I'd never seen such a frenzy for an alternative currency as Bitcoin. And whether or not Bitcoin itself is a valid store of value is not an argument I want to, get into. The point is that, we had a massive frenzy in an alternative currency at that time. And so my goal was to buy the hated, not the loved alternative currency, but the hated alternative currency. So I bought gold, and, it's done fine. I think it was close to 1200, low 1200s then. And so, I made a pretty good purchase, a pretty good sized purchase for myself, but, I have not bought gold stocks yet.
Steve, let's stick with Bitcoin for a second. I think one of the barometers for where the crypto is going is certainly the price, the volume, but people are looking at things like Google searches as well. I think the newsletter industry is a pretty good barometer of the sentiment around an investment, especially something new like this. What feeling are you getting in the newsletter business as to where sentiment is now versus say a year ago or even 6 months ago?
On Bitcoin or
Bitcoin.
I think it's an interesting question. We had our Stansberry Research has its one big conference a year, the Alliance Conference. It was October-ish, and I've never seen as big a frenzy as we had for any speaker ever in our history as we had for our two major Bitcoin speakers in October at our Stansberry event. So, and then it's really just disappeared completely. So Bitcoin is, I guess, reaching that hated point. I try not to invest in what I don't really understand. I don't have enough confidence to be an investor in Bitcoin myself. So, I've never bought any Bitcoin. I've never shorted any, gone long any. I've never bought any cryptos. So I'm not really any kind of expert in cryptos for sure. I understand the principles behind blockchain, and that seems like a technology that'll be around and change our worlds like almost like the internet did 20 years ago. But beyond just giving you the sentiment feel of, man, we were at an extreme in late 2017, and really it's fallen apart at this point. That's about all I can share with you.
Steve, why would you not just apply your own criteria, which, as you said, doesn't require you to be an expert? You just have to look for the cheap hated and the uptrending assets. Why would you not just apply that to Bitcoin as well?
That's a fair question, and I could certainly do that, and I have to admit that I have not been completely knowledgeable about some things before, and still invested when they were in that cheap hated and uptrend mode. For example, in 2011, I bought a property. It was under contract in 2009 for $14.4 million, and I made an offer. Ended up buying it for less than $1 million. I wasn't necessarily an expert in industrial property in Florida, but I bought it at a 95% discount for the price it was under contract for. 18 months before. And I felt like, okay, well, I might not be an expert in industrial property, but I understand, I understand what's going on in the mortgage world. And well, there's no money out there. The banks need to get rid of this stuff. And the discount I was paying was worth it. And and property, I feel like it's easier for us to understand property, and maybe that's delusional on my part, but it turned out to be a fantastic investment in hindsight. We've just recently sold it and made a couple times our money on it. So maybe if Bitcoin were to get significantly cheaper, I can't say never. It's not impossible that I would buy it, but it's not a plan to buy it right now. But you got me on that one. I mean, if something is cheap and it is hated, if it is an uptrend, I will take a chance as long as I use some sort of trailing stop, some sort of exit strategy to prevent myself from getting hurt too badly.
Okay, I want to move on, Steve, because I have a lot I want to cover. The year that you didn't like gold stocks, I believe what you did like was China technology. If memory serves correctly. Where are you on the China trade now? This is going back 2 years, I believe. But
that has turned out unbelievably fantastically. I was just at the Masters this week, and one of the top golfers was wearing a WeChat, sponsored by WeChat, which I got back from China 2 years ago, and I said, wow, the company behind WeChat is going to be the world's largest company someday. And that company's called Tencent. And Tencent has since gone up by triple digits. It is now the 5th largest company in the world, and no one had heard of it when I was talking about it 2 years ago. And China technology, the reason I mentioned the Masters, like I said, one of the top golfers, he had WeChat logos on his body, and some of our subscribers are saying, Steve, I'd never heard of WeChat before you. I'm seeing it on TV and seeing it at the Masters golf tournament. But so where am I on China? Well, it's funny, using speaking at your conference as sort of a barometer there. I think I spoke about China, and I got off the stage, and as I mentioned at our alliance meeting, when the guys talking about Bitcoin and cryptocurrencies got off the stage, they were mobbed by hundreds of attendees. Hundreds of people wanted to speak with them after they spoke. They wanted to ask them questions about cryptos or Bitcoin or whatnot. And typically, when I step off the stage, at least a few people want to say, hi, Steve, thank you for what you've done over the years, nice to meet you, something like that. Or they want to ask me about this recent pick, hey, how do which ETF are you recommending, or something like that. But after I spoke about China at your conference, not a single person came up to me after I spoke and said a single word. And I haven't had that experience in years, and I just thought it was a sign of the times about China, and that people are just not interested in investing in China. And so it was hated by Americans at the time, and that was a good sign to me as an investor. And still, at this point, Albert, people are still not interested in investing in China. I'm sure that the trade wars are bringing China back into the headlines. But Albert, when I'm looking for an investment, something that I want to see is a major difference between perception and reality. And if there's a huge gap between the perception of an investment and the reality of that investment, there's a way to make money in there somewhere. And when you travel to Beijing or Shanghai these days, or any major city in China, you're actually sort of stepping into the future. I mean, they're more modern than American cities. There's not an American city as modern as Beijing or Shanghai, which sounds crazy to say, except that I've been going to China for every year now, for years lately, and I'm taking a bunch of subscribers this June to show them, because you don't believe it until you see it for yourself, just how futuristic life is in China. And the perception of the Americans is that China is the sweatshop to the world, and that people over there are working for $50 a month, and meanwhile it's the exact opposite. You can't buy an apartment in Beijing that's livable for less than $1 million, and Shanghai's more expensive, and Hong Kong's more expensive than that. It is so people can't be sewing your T-shirt for $50 a month if they're living in $1 million apartment. It doesn't work that way. China is not the sweatshop to the world anymore. It's a different place than Americans believe it is. And anyway, there's so many pieces of the China investment story that are incredible. And so I'm extremely bullish on China and its prospects. And one of the things that I like is that no Westerners are really invested in China yet.
Steve, let's move on to your picks from last year. I recall that you were bullish on platinum last year. That was your commodity metals pick. One of the arguments you made was that it was cheap by historical standards, and we see now that there's still it's still trading at a discount to gold. So where are you on platinum? Maybe you could start by just going over the fundamentals. What led you to make that call last July?
Yeah, I'd have to look back at my speech, but I'm sure it's the usual suspects. Fundamentally, and you guys would be much more of an expert than me on this, but platinum was trading at, I think, a $300 discount to the price of gold, which historically, at least, platinum is traded at a significant premium to gold, and this was as an extreme a discount as we've seen in a while. And also, when you look at real money traders, the futures markets, you could see that platinum was as hated as it had ever been. And I think that's correct. Like I said, I have to look back and see, so we had China. We had platinum that was extremely cheap, at least relative to gold, and extremely hated based on what real money traders were doing. And then I don't know if we'd had the start of an uptrend yet at that point, but it was kind of the setup that I was looking for, and I was trying to find something bright to say about precious metals or find an opportunity. But we bought it in my newsletter, but I believe we stopped out of it we set a tight trailing stop and we stopped out of it. And we haven't been back to it since in my newsletter, but I have seen that, the discount to gold is even wider than it was last year, I believe. So, at least on that one metric, and obviously there are many other ways you can size up platinum and other uses for platinum, of course, than its precious metal use. So at this point, I haven't been on top of the platinum trade, but I would love to see. We do have this huge discount. It is off of people's radar. So if we did get another nice uptrend in it, I'd be interested. But it would be one of those things where I would be getting into it with a tight trailing stop. And one thing I like to do is if I set I want to have, as an investor or as a trader, I want to have sort of 3-to-1 upside, Albert. So what I mean by that is I could set a 10% trailing stop if I bought platinum today, and I'd say I would sell at a 30% gain. And what that would mean is that I have a 3-to-1 reward to risk ratio. So what that means in my head is that, look, I could be wrong 2 out of 3 times and still make money. I could lose 10% twice and make 30% once and come out ahead, so to speak. So I don't have Sprott's expertise in commodities and precious metals at all. I would check in with you guys and try and learn a little more and wait for that uptrend and then probably because I don't have that strong background like you guys, I would probably set a somewhat tight trailing stop and try and trade it smartly where my upside potential is greater than my downside risk.
Steve, that 3-to-1 ratio, is that something you apply strictly to commodities, or do you apply that to equities as well?
I try to. I mean, even better than that would be nice. And sometimes you can set yourself up with that type of ratio. But I think when you start setting these kinds of targets, you realize that wow, this investment that I thought was a good investment, when I really size up what's my upside versus my downside, you start to see that, well, it might be a good idea, but it might be hard to make it a profitable idea, or your odds of making money aren't as good as you thought, because you sit there and say, gee, it's really hard to make the case why this thing could go up 30% or whatnot, Or another thing is in gold stocks, someone may say, okay, they may not be willing. They have. Let's say you have a $5 gold stock, and someone thinks it's going to go up to $10. Well, if you're going to have this 3-to-1 risk to reward or reward to risk ratio, you've got to be willing to use a 33% trailing stop. So, and that's the math that I would use. And some people aren't willing to do that. Another thing that you'll see with gold stock investors is that they'll take a 50% profit, but they might set a trailing stop at 50% or something. And then you have a 1-to-1. Your risk is the same as your reward, and it's just not a good place to be. You have to be right a lot to make that work out. So I try to set that up across everything. It becomes a little more challenging in bonds to have that relationship, but it's something that it's just a good check on yourself of is this a real idea? And by real, do I mean, do I have upside? Am I protecting myself on the downside? And then you kind of start to dial in the numbers where you say, gee, this investment only has, it only has 30% upside. So unfortunately, I have to set a tighter trailing stop in order to potentially have the right ratio of reward versus risk. I know most people don't think in these terms, but I think it's really the difference between sort of amateur investors and guys that really end up making money is that the guys that make money they're playing a bit for the long haul. They don't mind taking a loss here and there. They know they're going to make money, so the idea is just to limit the downside. And it's a different way of thinking than I think most people approach it, but I've learned it's really the right way to go.
Steve, whether the investor chooses to use trailing stops or not, I think that exercise is very useful because by your calculation, if you come out with a 30% stop that you're uncomfortable with, it's probably an indication that you're swimming in the wrong pond, right? That this sector is too volatile and risky for you.
Exactly. I mean, if you think, well, I need to allow it. It's a volatile stock, so I need to allow it 25% downside risk just for market volatility. But if you think your upside is only 25%, it's a bad idea. I mean, it's not a good reward to risk idea. And it's really about changing your thinking in how you size up ideas. Like one way of thinking is, oh, I like this idea. Oh, I like this project. Oh, I like this property, whatever it is that you're looking at. But then when you start to size it up in reward versus risk, currencies also are challenging like that to really get that 3-to-1. But it's just a good sort of reality check.
Very good, Steve. We're running out of time. I just want to remind the viewers that you're going to be joining us again July 17th through 20th in Vancouver. Go to sprottconference.com for details. Steve, can you give us any clue as to what you'll be talking about this year?
Well, what I can say, Albert, is finally, you may be glad to hear this, just this month I recommended in my True Wealth Systems letter, really came out last week, I recommended going long commodities as a whole, which I haven't done in a while. And you can actually buy commodities today. If you look at the Bloomberg Commodities Index, the value of the Bloomberg Commodities Index today is the same as it was in 1991, Albert. So you can buy commodities today at the same price you paid in 1991. Now, if you look at stocks, they're up, over 1,000% in that time. Real estate, pretty much any asset class has absolutely soared. But commodities you can buy at 27 years ago prices today. So I may finally have a commodities pick for you. It's been a little while. But a big story at the Sprott Conference this year.
Steve, where can people find out about that newsletter?
The best place to get to know me is probably our free letter, dailywealth.com. And I believe you can sign up there, but otherwise, StansberryResearch.com is our business's main website. So, yeah, thanks, Albert.
Yeah, thank you very much, Steve. I don't know about the cheap and hated, but I saw Porter gave you a pretty good letter grade this year at the Stansberry Research Review, so you're definitely on an uptrend. So I look forward to seeing you in Vancouver and listening to all of your ideas, Steve. Thanks very much for making time.
Thank you, Albert. I look forward to seeing you there.